Here is the bottom line when it comes to investing and the truth behind managed funds versus passive ones. Over the long term, the numbers don't lie, and I'll be honest, things do not look good for the managed fund sector and all those highly paid fund managers. Over a period of 10 years, 78% of large cap institutional accounts and 77% of large cap hedge funds fail to beat the returns of the S&P 500, and that's even before you take into their fees into account. Once fees have been removed, things get even worse, and you can then add an additional 5% on top of those numbers. This means that in well over 80% of cases, you were much better off investing in a passive index fund that was low cost and not having to worry another day about where to put your money. Why even pay active fund managers money if they can't deliver on their market-beating returns? Well, this is an interesting question and something we need to take a closer look at, because it is possible to beat the returns of the market, because it's going to require a little bit of work and a bit of strategy. You might need a slightly bigger tolerance of risk too, but if this sounds like you, then carry on watching the video and we'll explore how to pick funds that have a much better chance of outperforming rather than just the flip of a coin. Let's dive into some more of this research and data to get into some of the more interesting details. All of this information is publicly available and collected by an organization called SPIVA, which is a division of S&P Global. Yes, that's right, the ratings agency Standard & Poor's. Every single quarter and every single year, they put together reports which outline all of the managed funds and how they performed compared to their index, the world famous S&P 500. They do this both in the US and internationally too, to see how different geographies compare. But surprise, surprise, mostly the outcome is the same. Passive funds end up crushing the active funds in the long term. Honestly, it's surprising the active fund industry doesn't just give up already, but I guess there's too much money to be made. So who can beat the market then? What does the data show? Well, there are a couple of standout bits of information that I wanted to share with you that I think are great opportunities for investors with a keen eye and a sense of adventure. The areas which seem to have the best opportunity are in small, mid-cap and even value investment funds. The research from SPIVA showed that during the last year, small and mid-cap funds were able to beat their respective indexes a vast majority of the time. In fact, 86% of funds were able to beat their indexes. That is really impressive indeed. Even in value stocks, which did not include just small and medium-sized companies, the results over the year look pretty good, with 71% of large-cap value invested funds outperforming the benchmark of the S&P 500. So actively managed funds are not quite dead in the water just yet then. It sounds like all of this comes down to making sure you pick the right fund and then also making sure you get out at the right time. Timing in this area seems to be one of the most important factors, which we know with the overall market is not possible to do. One thing we need to look at here and remind ourselves of is that the funds that typically have an amazing year almost never go on to have an amazing year in the following time period. A lot of research has been done into this topic and it's really fascinating to look at. Almost everything reverts back to the mean average. Just look at some examples which come to mind. Think of the amazing run that Cathie Wood's ARK Invest ETF had in 2020. The returns were incredible, as the fund included companies like Tesla, Zoom and Square to name just a few, who all had amazing runs throughout the year but have since cooled off and declined slightly. In fact, for the year to date so far, ARK, which is ARKK, is underperforming the S&P 500 index by quite a way. ARK's 1 year performance is at 4.38%, where the index is up a whopping 32% currently. And the issue that this causes is that many investors have flooded into the ARK Invest funds, chasing the performance of previous years and then expecting the same returns year after year, which just do not happen. Even Berkshire Hathaway, Warren Buffett's money printing machine, can't always achieve the returns of the market each year though. Sometimes they get beaten, but the aim is to beat it over the much longer term, which really is the challenge. So what have we learned so far? Actively managed funds can beat the market, especially those in the sector of smaller companies and also over shorter timescales. We get funds which can make some significant performances, but we shouldn't go chasing funds with great performances over the short term, as they are highly likely to not get the same result in the following year. All of the data from SPIVA and Morningstar shows how time and time again, top performing funds flop in the following year and cannot keep performing well consistently over long periods of time. So this leaves us with a few good clues to start our investigations into finding these winning funds, because they are out there. We just need to be good detectives in finding them. Here are my top tips based on the research I carried out from some of the best investors in my back catalogue of reading. Firstly, we need to stick to the specialised and smaller and mid-cap stocks. There's almost no good reason to chase funds which have large caps in them, as this is a lot harder to move the needle with those funds and significantly more challenging to get returns that deviate from the S&P 500 index or otherwise. Smaller and mid-cap stocks can and do perform well. They can much easier adapt to different working conditions and show their agility during challenging times in the market. However, they are also liable to a lot of downsides, especially if they are carrying a lot of debt or operating in a sector that is reliant on just one or two sources of income. Secondly, we should look to find funds that have underperformed or even poorly performed. Hear me out on this one. Just as after every bear market there's been a bull market, so long as the companies within the fund remains to have an edge and you can justify some strong conviction in each of their financials, you could easily justify taking a position here for a speculative bet. The one thing we cannot fall into as investors is going to chase the funds which have performed very well in the last year without actually considering if their basket of stocks they've invested in will actually outperform again. We should definitely run our analysis for a second time to see if this is at all possible. And finally, look to funds that are more specialist. Although there is not quite the data to back this point up, the more the fund is specialised in a certain sector, the more it will deviate from the wider market. In my opinion, there would be no point investing in an actively managed fund unless it has a clear sector of the market that's trying to get exposure in. For example, there is a fund that's looking to invest in stocks in the metaverse, or you have funds in track sectors like clean energy and water. These are a lot more appealing to me than just more generally selected stocks put together because they've been defined as having a better chance to outperform the market. So let's just briefly have a look at some of these different specialized funds that I've been talking about, especially in kind of more specialist sectors, or even in that small cap and mid cap that I was talking about earlier. And kind of what I was hinting toward in the start of this video is really that the funds you want to be invested in, at least to try and get some of those extraordinary gains, and certainly gains which are going to be market beating, will need to be specialized in some way. Otherwise, they're just going to end up reverting back to the mean and reverting back to the performance of the market, and most likely though underperforming it. So some of the sectors, of course, you've got, and let's just have a look here. I'm just going to go through. So for example, we've got another BlackRock one here. If we think about the iShares Global Water UCITS ETF, I'll tell you what, that is a great ticker symbol, isn't it? IH2O. Now, of course, this is in a very, very specific sector of the market. And of course, it's going to be highly speculative, and you're going to be relying on these innovative new companies to treat and look at the way that we utilize water. And we do know throughout the world that water is an essential resource. There's no question about that. And we are going to need to be more clever about how we use water in the future. So something like this may be where you would start your research. I'm personally not invested in this fund. I have no plans to in the short term. But certainly funds like this do interest me, rather than trying to be clever about individual companies that you pick. If you look at a fund like this, we've got 51 different holdings in all of these individual different companies. Fairly well diversified in terms of the spread and the weight, although there's of course a couple of companies who have quite a strong weight here, this American Waterworks company and Xylem Incorporated. But then we have lots of others who are going to go around the world too. And of course, if you just notice down here, even including United Utilities and Severn Trent, here based in the UK, which is quite interesting. So this is a potential starting point. I would be less interested in extreme performance, as I've mentioned before in this video already, about looking at charts and performance. I'm not necessarily bothered about saying, wow, this fund has done 100% in the last year, because if anything, that would probably red flag for me. You're kind of having to go here a bit off intuition and thinking what is going to happen in the short term, in the future, and where the demand is going to be, and making sure that you actually have a price target in mind, a performance in mind, and get yourself out. But this has been quite a popular and a famous one in lots of people's portfolios, this iShares Global Clean Energy. As you can see, it's had quite an interesting year, shall we say. Certainly a big run up in 2020. Pretty much after the CV dip, it's had a ridiculous run from kind of just over 400 to up to 1200. I am still slightly down in mine. I think I bought mine just under 1,000 on the way down, thinking that was the dip. And obviously there's a huge mistake there for you, thinking that was a dip. Anyway, it will definitely be one I'm going to be holding long term in the portfolio. But again, let's look at our kind of a checklist and tips and tricks here. So highly specialized, global clean energy. We know this is kind of the future of where the world is going. At least we hope so. We don't necessarily know which companies are going to grow that. So this basket gives us 76 different companies that we're able to look at. Not too crazy of an ongoing charge, 0.65. It's certainly no cheap index fund, but we are going to get exposure to all of these different companies in the sector who are trying to achieve different things in that clean energy sector. And of course, you will notice some of the impressive names here, certainly big American names like Enphase and Plug Power for certain. A lot of the other ones I'm certainly not familiar with. I'd have to properly look into these, but we do get some global exposure here, as you can see from some of the other names across the world here. Of course, we can have a look at the countries. We're still going to be dominated by the US. We are going to get some exposure here across Europe and even good old UK here at just under 4% too. So this could be another place to start. One final one I was going to bring up as well is quite an interesting one actually. So there is an ETF which tracks the electric vehicle market. And this one, I believe, if I'm not mistaken, has a ticker symbol. There it is, ECAR. Again, some great ticker symbols out there. It's almost as if they're trying to use that marketing to get you to buy in. So again, another BlackRock ETF here of a fund of collecting any stock involved in the electric vehicles and driving technology market. Again, I'm not necessarily bothered about the crazy performance in years gone by. I'm more worried about forward thinking here. Number of holdings, this one's got 90 different companies. There will be no surprises who will be at the top of this list, I've got no doubt. There we go, surprise, surprise, it's Tesla. But quite interesting here again, we've got lots of companies who aren't necessarily all making and creating different electric cars, but it's the other companies who are surrounding building of electric cars and chip makers, etc. So you'll see, of course, Nvidia is actually the second largest holding here. And then, of course, companies like Samsung too, quite interestingly. And as we know, if we think about this sector and we think about the specializations of this sector, companies like Nvidia and Samsung, we will need their technology in order to build these smart electric vehicles with all the autonomous sensing and everything else, and other chips that we're going to need to read the road and to understand what's going on. So again, could be one to look into. This is just really to give you an inspiration of things you might want to hunt for in different areas, in different niches. But the only way I think a fund is going to necessarily beat the S&P 500 market or the general broader market is going to be more specialized, smaller. It's definitely going to be riskier. So you would have to make sure that you have an idea of where you want to exit, where you want to enter, and stick with that. And as always, make sure you stick with a broadly diversified portfolio as your core and never put too much into it. But hey, do all of your own research, but this could be some interesting places to start. These specialized funds help you for a number of reasons, as they save you the pain of having to research dozens of companies in a sector. Instead, just give you the wide chunk of the sector in one go. We know that historically this approach has worked well. Just think back to the dot-com bubble. Hardly any companies in that time survived the crash, and you would have certainly been some kind of genius to be able to predict that companies like Apple and Amazon would not have only survived, but ended up thriving. Can you imagine holding Amazon from its highs and seeing it all go all the way from $100 to less than $10? In conclusion then, it is possible to beat the market. Yes, it is, but do not underestimate how difficult it is and the large factor that sheer luck will play in making this happen too. Nobody knows what will happen in the future, and we cannot know where the next sudden spurt of growth is definitely going to come from. In the short term, if we were strategic and careful, taking profits and not getting too greedy, using active funds could be a great way to play the market and benefit from those returns, even when we factor in the higher fees and costs of playing in this space. But we can't get away from the facts that over the long term, it's still a very challenging thing to do, and most people will always be better off just holding on to low-cost passive index funds, or at least having it as a core of your portfolio. This is certainly my own strategy, and I will continue to hold on to the wider market as the majority of my holdings, whilst at least trying to pick some individual winners using managed funds and also individual companies too. So far it's worked out well, but I am under no illusions that it could fall apart at any moment, so I remain skeptical and vigilant. You still need to do all of your own research and carefully choose investments without letting emotions get in the way. And you certainly need to make sure that you seek out professional financial advice where you need it, as people like me are definitely not financial advisors, nor pretend to be. It's your money, so be very careful with it, and hopefully you can make some awesome gains out there and reach whatever goals you have. Anyway, I hope you've enjoyed today's video, and drop me a like if you have, subscribe for more if you are not already, for many more videos in the future, and I'll see you guys all in the next one. And as always, happy investing.